Well, good afternoon, everybody, and welcome to another economic and RBA update. And we've timed it differently again this month. It's been another 6 weeks, and we've got the RBA meeting. So I'm here. I'm joined by Evan Lucas.
And what a 6 weeks!
Yeah, so we are. There's going to be a lot of fun in terms of covering it. We've got about sort of 9 minutes now before the RBA makes their rate call. So what we're going to be doing is focusing on the Australian market first, with that RBA rate call. And what I wanted to do in the lead up to 2:30 when we get the announcement is to talk to effectively some of the bigger items that have happened in the last 6 or so weeks. And obviously the biggest one is that Labor won the election, federal election. And so we've got another 3 years, maybe.
You'd argue probably 6.
Maybe the way in which they won.
If you look at where they currently sit, 49 seats. I mean, they broke up. I mean, we're doing this on the 20th of May.
Yeah.
And as we speak, the coalition is officially not the coalition.
Yes, that's right. They are now separated. They're now
separated. So
for the time being.
The Liberal Party, the National Party is two minor parties.
Yes.
So the probability of 6 years, I think,
maybe
needs to be discussed. Look, I've got my green text already because I think the main thing to discuss is fiscal policy.
Yes.
Which is going to be the discussion from what happened on that second weekend in May. We need to look at the cost of living relief that we have been getting.
Yeah.
Now is no longer a political football. It's a getting to government reality of what they need to do. That will be the debate. So I think we may even hear it in a couple of minutes' time around, do we keep going with fiscal, policy the way it is?
Yeah, it's an interesting question because obviously the way in which Labor, talk to their base is they do a lot of cost of living relief as part of that particular story. Yep, and we see it all the time where effectively they spend money that we don't have. They go into further deficits to obviously continue to stay in government to enact their policy and ideas. Now, obviously the byproduct of that is it potentially has the risk of keeping inflation higher. And so that was something that we debated at the start of the year and even at the end of last year, that there's no doubt that with the amount of government spending and spending in health, education and services areas, and obviously that has led to inflation remaining higher, because traditionally at the level that the RBA pulled the brakes, you would normally have seen an acceleration of unemployment, and that would have meant that the interest rates or inflation would have come down quicker, and then potentially you would have got the interest cuts that we thought we were going to get last year that didn't actually materialize because job stability was there.
Yeah, not only that, as you said, those three sectors make up over the last 18 months 57% of all employment sectors. You would argue that is nice, but too high. I mean, again, this is why you keep hearing the Treasurer talk about the care economy. There's nothing wrong with the care economy. They still haven't worked out how you actually look at that productively.
Or pay for it.
But it's the big one is the energy, rebate that's now been in place for 18 months, 2 years.
Yep.
And it is scheduled to come out of the budget by December. There are even, welfare groups saying right now we need to stop that and put that more targeted. So fiscal is going to be interesting because they've got a mandate, so you can't deny that. They've won quite strongly, can't deny that. They have the right to do what they put in place. There is a big however, and the however is if they continue to make the RBA's job that little bit harder, we will be talking about this for that little bit longer, and we will therefore have that little bit further down the track of the biggest issue with monetary policy, which is that we've got a sledgehammer doing fine art, which is something I've said many times. We realistically have two things. We have a very, very strong, not hot, but strong housing market that Ben will get to after we do the rates, and everything else. They want to stimulate the everything else. But what we've seen from particularly, modern history, it'll stimulate the housing market.
Yeah, look, and we know that wherever government is the main buyer of the goods or services, and there's effectively no market checks on that, inflation runs rampant and costs blow out. So you think about that logically, health, you think about that in education and those, services that we do. When the government is infrastructure projects, they always blow out because they're providing the money and they're the customer. They're borrowing the debt, and so those things ultimately blow it, which is inflationary in their aspects. Now we're getting pretty close now. We're sort of at around a few minutes to go. The other one we wanted to talk about in terms of how you try and get monetary policy and fiscal policy. We saw there's also student debt. Mm-hmm. There's 20%. So we've been telling everyone, just wait, don't pay any of your student debt down until the 1st of June, because that's obviously where the date is set. So whatever your maximum debt is, you're going to get 20% off your student debt. So there's a lot of students through debt, through borrowings,
or this controversial plan around the $3 million cap on your superannuation. Yes. And the unrealized gains.
Well, wait a minute. No, come on. Jim Chalmers is telling us that's for health and for education services. He didn't say it was for paying off students' HECS debt, but we all know it goes into one bucket.
I will keep the cynic in me going quite strong in the fact that, and not only that, the fact that it's only 0.5 of 1% today. As most people want it, in the next 10 years, it'll actually go up to about 1.9%. In the next 20 years, it will be 1.9 million people
paying their way. Oh, but he's telling us
unrealized gains.
He's telling us
where's that money coming from the super fund? That if you're having to pay a tax on unrealized gains, you have to capitalize.
Hey, normally it's me taking it on the government, but yes.
Oh no, when it comes to this
it's a dumb idea. Taxing unrealized gains.
Realized gains, go for it.
Realized gains, we get the story, but the fact is that we'll have to be selling assets to pay for unrealized gains.
Yeah, it's just a horrible.
It's a dumb idea.
We'll come back to
stupid idea.
We're running out of time. 2 minutes. So the next thing that you were talking offline, we need to talk about now.
Yes.
Are the banks going to pass it all through?
So this is my prediction. So it's either going to be today's 25. We're making a prediction that's 25, could be 35. We put a rule under 50. Won't be 50, right? So that would, both of us will fall over. We'll quit. We'll know nothing about economics.
Yeah, correct.
It's if they drop 50 basis points.
No, that Michelle Bullock should probably also quit the communication, which has been really good.
That's what I meant. That's why it's not going to happen. It's not going to happen.
Would just be completely shocked.
But the board will just lose all credibility. Okay, so here is my thesis in terms of why I believe it's going to potentially. That I reckon the big banks, one of the big four banks, is not going to pass on the full rate cut. I'm anticipating that's a 25 basis point. They'll hold 0.5 back because they've got net interest margin problems with all of the cash splashing that they did.
So can I name the one I think is not going to do it?
Okay, go for
it.
ANZ. You think ANZ has to potentially be the one that doesn't pass on the full 25 basis points?
So their net interest margins at their last update was 1.5 and a bit %.
All right.
So that's my pick.
All right, so let's now go and have a look, and we're just going to bring up
15 seconds.
Very close. We're still
watch that space. That will be the big blow. I think they'll actually all go. It will be the next one we can have that debate on. But I genuinely think that
politically this is the time to do it. This is politically the time to do it because the government's just won, so they're not worried about coming into an election. So let's hit this refresh. Oh, are we a fraction early?
We would be one of many, many people clicking refresh on this.
There it is.
So we have got
25 basis points.
Yes.
And down to 3.85.
So I'll get out my green texter and I will start going through the statement because that will be the big part here now is what the statement actually has. As expected, you can see on the chart, we now have a cash rate of 3.85% from 4.1%. All eyes now on how that statement looks. So maybe we should bring it up and sort of start reading through on screen because they have been so very strong, very, very strong on data dependent. So first and foremost, before we go through the statement,
yes,
it probably also makes July interesting because the July meeting is the 8th.
Yep.
Between now and 6 weeks' time, so July 8th, there isn't really any more data.
No.
So it probably makes May and then August the interesting one because August will then all of the second quarter data will come through. So that's what I will assume we now need to talk about is still remaining data dependent, what they see around the geopolitical issues in the around the world, how they see inflation tracking in Australia. And I want
Here we go.
Ben's going to bring this up. There's a lot of red.
Through. So there's a lot of change potentially between the two different statements. So whilst Evan does a quick study, I'll take over here. One of the things that is important for us to understand is in relation to how many rate cuts we're going to see, right? So I think that's what most people are potentially going to be thinking about. They're going to be thinking about, all right, well, we've had one earlier in the year. Now we've got our second. Are we going to have 2, 3, or possibly 4 more? And I think what we're going to see in this statement from the governor and the board, and potentially from the press statement, the press conference that will be held in 30 minutes' time, is that there is still uncertainty. And I suspect they're going to tell us that they will continue to remain data dependent. So they're not going to rush.
So what do we get? So Ben just hit one of those points. There is an entire new paragraph about the outlook. So the uncertainty in the world economy has increased. I love this line that while recent announcements on tariffs have resulted in a rebound in financial markets, there is still considerable uncertainty about the fiscal scope of the tariffs and the policy response in other countries. This is what I said last time, was that, and I say this in behavioral economics, for every government action, there's an equal but opposite taxpayer reaction. In tariff world, for every sovereign government action, there's an equal but opposite other sovereign government action. Now, China, US, and I don't want to spoil what we're going to go through later in this, but that's part of it. But also, I mean, we've done it as well, and we're going to talk about this as well with regards to Europe. For the first time in many, many years, is the closest it's been to doing a free trade agreement with Australia than it has pretty much at all, and that's because of what's happened with the tariffs. So this is very big changes. Like, there are huge increases of text here. I think it was also...
So the board judged that the risk to inflation has become more balanced. Inflation is in the target band and upside risk appears to have diminished as international developments are expected to weigh on the economy. So we'll get to that in terms of that. With inflation expectations remaining around target, the board therefore judged that an easing in monetary policy at this meeting was appropriate. The board assessed that this move will make monetary policy somewhat less restrictive, probably giving us a little...
That's still not saying it's neutral either.
No, that's right. Nonetheless, they remain cautious about the outlook, particularly given the heightened level of uncertainty about both aggregate demand and supply. The board considers that a severe downside scenario and noted that monetary policy is well placed to respond decisively to international development. So they are signalling there that...
Powder dry.
Yep. And if the proverbial hits the fan, the reality is that they will pull the lever harder than they expected. But in the interim, if we maintain that 2.5% target inflation range, we'll continue to see further easing throughout the course of the year, is pretty much where we see it.
This is starting to move back to the RBA of 2016, end of 17 through to 2019, where there was actually an argument at the time that inflation was too low. Right.
We were trying to pump some.
Yeah, we were humming about between 1.5 and 1.8. I mean, wouldn't that be a lovely thing to some extent? And there was people, pointing out that they were not maintaining their mandate, which was that actually inflation was below where it should be, and they should have cut rates. And they kept saying at the time, because the cash rate was about 1%. Philip Lowe, and before that, Governor Glenn Stevens was saying the same thing. We need powder dry. We need bullets in the gun. Their ammunition was their term. And we got COVID.
So they did the right thing. They were surprised back then also about the lack of wages growth. Because employment was...
They were also surprised by the lack of just thirst for lending. They like, this is the cheap. I mean, at that time, it was the cheapest it had ever been. Because COVID hadn't happened. And, as they were sort of saying, you can lead a horse to water, you can't make it drink. And there was this problem that Australian business just wasn't taking risk and didn't want to take risk. And no matter what they did, they couldn't stimulate the economy to get out of this sort of strange lull period.
It's interesting time.
Which we now look back with sort of fond memories.
Well, now we're coming off that higher inflation period. Let's start to talk about inflation in more detail, because this is the big story that is setting where policy adjustments are taking shape. So
I'm going to apologise in advance, because buckle up for some charts.
There's a few charts coming through. And I've just realised that I'm struggling with my synchronisation here, but bear with me. I'll just read through some of the data that's coming through. So this is data from the ABS that was released on 30th of April. And it says Australia's inflation rate held steady at 2.4 for Q1, remaining at the lowest levels since Q1 of 2021. Services inflation, which is a good news story, eased to 3.7, the softest since Q2 of 2022, and down from 4.3% in Q4. Now, it was driven by slower increases in rent and insurance costs, and we know that they were in double-digit territory, so that is a good news story. However, this was offset by a rise in goods inflation, 1.3% versus 0.8 of 1%, largely due to electricity price surging 16.3% after a 17.3% decline, following the second round expansion of energy bill rebates to included to all households. Food inflation also picked up 3.2% versus 3%, driven by higher costs of meat, seafood, fruit, and vegetables. On a quarterly basis, consumer prices rose 0.9 of 1% above the expected 0.8 rise, which got a few economists a little bit sort of that surprised on the upside, and marking the largest increase in 3 quarters. Now, of course, we're going to see a bit more of this in terms of the trim mean stuff that Evan's going to take us through.
So first and foremost, you straight away can see the slight issue with how we sometimes evaluate inflation as overall. So take that electricity price, it is a rolling 12-month period. Yep. So you are going to get these unknown numbers where really strong months from a year ago will roll out of the data, and you're going to get this massive movement down or up.
The base effect.
And so that's why, if you saw in the statement before, they said very clearly that why they're now more confident with inflation, I'm going to show it to you in a minute too with the rolling 6 month, is that although headline inflation might move around quite rapidly because particularly of the energy rebate and where that sits, how that will roll in and out, that it could even see, headline inflation going back up into the 3 handle rather than where it currently sits at 2.4. The trim mean is the one to watch. So the chart here shows for the first time since 2021, trim mean is inside that sort of fawn-coloured band. We are back inside the target, which is the RBA's preferred measure of inflation. You can see that it also is a laggard, right? It tends to be behind headline inflation. Again, food and fuel is a volatile thing. So that's not what I want to concentrate on. I want to go over the next sort of 3 or 4 charts and sort of really push into what we've basically just heard from the RBA themselves, which is trim mean and weighted mean are there. So this is a good news story. This is what we wanted to see. But the one that really caught my attention is this. So this is trim mean, back into target. But the RBA is still very clearly uncertain about where it's going to go. So the NOV SM 24 means November 24 Statement of Monetary Policy, and the February 25 is obviously the one we just had. They are forecasting trim mean to stay at 2.7% for the next 2.5 years. Now, that's extraordinary for the RBA to say 2.7. What that means in our world, they don't know. And not only do they not know, realistically, what they're saying is that they've got clarity to probably Christmas, but they don't have any clarity outside of that. And therefore, it gives them basically, leeway scope.
Look,
bull and bear cases.
It sort of makes sense, right?
Yeah.
Powder dry moment that we were talking about before. Remembering that the 2.5 is the midpoint between the 2 and 3% target range that they're trying to get to.
And the Hawks will point out, why are we cutting rates when they're not even forecasting getting to their target point of 5.5? The Doves of the world saying we're back in it. The momentum's in one direction and away we go. So on the momentum, I'm going to just skip across that one and come back to that. The momentum is this, right? So if we take out and smooth out those 12-month rolling averages where big data points roll out, it actually looks better. So we are probably at midpoint in terms of the trim mean figure, where it sits, what it is. We are showing that overall annualized monthly gains now are 0.6, which is actually back in trend. So to stay at the midpoint needs to be staying sort of about 0.5 on that sort of month-on-month, quarter-on-quarter period, and needs to be looking at around about sort of that 2.5 number. So we're there. But the other thing to show you, and why I'll go back to where we were before, is Australia tends to actually be a follower, not just in markets, but tends to be also in other things. And just to show you that for the first time since the spike, Australia is now actually below the rest of its comparable advanced economies on inflation. So
that little
jump up, and we've seen that in Europe. We saw it in the US. We've seen it across places like Canada. We've just started to see this uptick in inflation. And not only that, don't forget, the tariffs discussion isn't really there yet. This is first quarter.
Correct.
So
and it's off the back of them being 6 to 9 months in front of us.
Yep.
So in a sense, what's happened is, when obviously the cash rate goes down, it frees up more money in the economy,
and they were both,
and people then spend a little bit more because obviously prices can go up a little bit more, and so you get that little spike.
Yeah, and if you look at that chart, you can just see that the orange line is ever so slightly to the left, which means it's front running what we do. So it is just a caveat, which again gets back to what we said before. The July meeting will be interesting, but probably not as exciting as what we've just gone through.
All right, I thought you summarised that beautifully in terms of what we're looking at here. So we obviously did that one, and then we've got so off the back of that, we always like to look at the employment story. So remember, the RBA's mandate is to have full employment, and of course, inflation and full employment are their two sort of core objectives. So let's quickly just run through what we saw in the 15th of May release from the ABS, and what did we learn around seasonally adjusted unemployment. So it stood at 4.1% in April, which was unchanged from the previous month and in line with market expectations. Now, the number of unemployed people increased by 6,300 to a reading of 621,000, with those seeking full-time jobs rising 9,300 to 433,000, whilst those looking for part-time jobs dropped by 2,900 to a reading of 188,100. Meanwhile, employment rose by 89,000. This number surprised a lot of economists,
including me.
Yeah, in terms of to a new record high of 14.64 million people employed. Remember, you have to work 1 hour within the month, or was it something very similar to be employed. Now that
or looking for work. So correct in the market.
Now there were forecasts for only a $20,000 increase in that particular number, right? Now we also had a upwardly revised 36,400 in the March result. So full-time employment increased by 59,400 to that another all-time high of 10.07 million. Part-time employment grew by 29,500 to a record peak of 4.757 million. And the participation rate, and this is what kept the unemployment rate at 4.1%, increased to a 3-month high of 67.1 from 66.8. Geez, I'm getting my numbers all over the shop in March. Okay, now this is the interesting thing, right? So we're basically saying if we didn't have an increase in the participation rate, then the unemployment rate would have dropped.
Yep.
And that wasn't necessarily being forecast by anyone. So it shows the strength of the employment market. We saw the underemployment rate edge up to 6% from 5.9, and monthly hours worked also climbed by 1 million to 1.964 million. So this job story is powerful, and it's potentially one of the reasons why the RBA may continue to keep the powder a little bit dry.
Yeah, and so I think before we go any further, we need to ring fence this out. So this is actually really, as Ben said, strong stuff. In fact, it's more than that. It's actually quite incredible, particularly, going further in that participation rate. Women participation rate continues to make record all-time highs. So it's now at 63.9 compared to men, which currently sits at 71.2, 3-month high, not as record. But more and more people, as Ben said, we've got 14.5 million people employed in this country out of a possible population of employed people of about 21, give or take. So that would make up your 67% of the working population. Don't forget 16-year-olds are included in that, so they technically should be at school. So all of that's there. What it also shows is, again, there's an underlying resistance in the economy because of public spending. I mean, 57% of the employment market, as we said before we went to the RBA, is health, education, government services sectors. are a big part of that. And we saw that in the wage price data.
Yeah, well, it's a good segue into that wage price data here. So we saw this also released around the middle of May. And what we got here was a Q1 result. So Australia's seasonally adjusted wage price index rose by 3.4% year on year in Q1, up from 3.2% increase in Q4 of last year. The latest figures marked a rebound from the previous quarter, which recorded the weakest wage growth since Q3 of 2022. The acceleration was driven by stronger wage growth in the public sector, what we've been talking about in terms of when the government's paying. There's pressure on wages, 3.6 versus 2.9 in Q4 last year, whilst private wages growth held steady at 3.3%, which is the lowest since Q2 of 2022. In original terms, electricity, gas, water, waste services industries posted the highest annual increase at 4.4%, followed by education and training at 3.8%, healthcare and social assistance at 3.8%. So they're above that result that we got at the 3.4%.
So let me be facetious again on that, right? Electricity, gas, water.
Essential services.
Energy, electricity being the highest. Energy rebate.
Mm-hmm.
Being passed through. The way it works is that the government's paying the energy provider to give you a 15 to 20% haircut. Right? That's how it works. So instead of you getting it in your pocket.
60%. Energy costs have gone up 60% in the last decade.
Yeah. So what they are doing is that so that you don't see that increase, they have been giving the retailer energy provider the cash injection.
Correct.
And therefore on your bill it appears cheaper.
Yeah.
But
the government's giving the money, and guess what? They're passing it also on to employees.
So they're keeping their employees.
Yeah. Because at the end of the day, it's an essential need, and government's the buyer, and government is the buyer on behalf of us.
Inflation. So yeah, that's my facetiousness, is that when I saw this, it fascinated. Second thing to sort of say, what this chart is possibly also missing out on is that if you stretch it out over 20 years, we still are at above the historical norm by about 0.5 of 1%.
Mm-hmm.
It's also now, with the inflation figures in there, the largest real wage growth that we have seen in 15 years.
Again, and so Labor will claim credit for moving wages, but this is still something of a concern for the RBA in terms of whether we have a wage price spiral issue coming out here. Now, they should take comfort in the fact that it's predominantly public sector money. And that's why we're also seeing in New South Wales a lot of these protests in public sector jobs. They're looking for big increases, and the Premier saying you're going to send the state broke. Don't worry, Victoria's already broke. It doesn't stop Victorian governments from spending the money. There's my jab at them on their budget day where they threw away more money and wasted more money.
$194
billion. $12 billion a year in interest repayments at peak debt. Just ludicrous in my mind. Anyway, main industries contributing to the quarterly rise was the roles in healthcare and education and training. On a quarterly basis, wage prices climbed by 0.9 of 1%, up from 0.7 from the previous quarter. So they'll take some comfort in that number in terms of that increase. But we'll keep an eye on this, because this one could be a derailer for us, because we've got to keep wages growth in line. If inflation's coming down, hopefully the pressure on wages growth will ease, because we've got to get that balance right. But whilst there's full employment, the reality is the market of supply and demand. If you're looking for good people in your business, potentially you're going to have to pay to have them stay or to attract new people to grow your business. But let's move on to good segue into consumer sentiment. And what did we see in terms of the Westpac Melbourne Institute consumer sentiment reading for May? We saw it increase to a reading of 92.1. Now, the index has recovered a third of the April tariff war related falls in terms of confidence. And we saw solid rebounds in views on financials led by share market rebalancing. I wouldn't call it really a rally. It was trying to recover from the collapse it had off the back of the big turnaround. If you timed that well, if you got out, you would have made a small little fortune. Anyway, and obviously lower fuel prices. Oil prices are at lovely levels. They've got an 8 in front of them at the moment. And even 7s or 6s, has it?
So Brent is $60 a barrel.
We buy the Singapore crude price. What are we at?
Tapas, which is currently 71.
Thank you. Very good.
And
My
which
apologies.
means why at the Bowser you're probably seeing across the country about $1.50 to $1.55 average.
Oh, I wish I maybe put my
Premium
fuel in my car, diesel. Benign inflation shores up consumer expectations. So we are seeing here that in terms of the economist who did this report, he said that benign inflation is shoring up consumer expectations. So we would expect to get a bounce in the next consumer sentiment update that we'll get next month.
The question that'll bring, if we go back to that chart.
Stay here. Yeah.
Don't forget, 100 is between optimism and
pessimistic. So we're still more pessimistic.
We saw that big leap up after the February rate cut. Do we actually go through 100? That will be the question. 8 points.
Oh, yeah, it's a good one.
It's a good question.
Yeah.
So not only that, the election is done, right? So that is out of the data as well. As I said before, the last one is that it doesn't matter who gets voted in. There's actually a honeymoon period of about 4 months with confidence after an election. So a known election result, doesn't matter who won, and a rate cut.
So what's going to be our saving over the course of the 12 months if we factor in another couple?
So if we factor, so the average Australian mortgage is 660,000.
Yep.
Which means today we'll bring that down by $100 a month.
Yep.
If we get that third one by the end of the year, not taking in the possibility of the fourth, it's $3,300
for the two.
For the two, plus the possibility of one more.
Yep.
So, that's
meaningful.
That's meaningful.
The 3,300 is meaningful.
Yeah, interesting data that came out of CommBank last week when they did their quarterly update. They actually found that only 14% of their owner-occupiers have refinanced their direct debit down to the minimum standard rate. So most
they're
people
still paying their mortgages off quicker.
Yeah, so we call that banking, right? So they're banking the interest rather than actually spending it. So that will be the other question: is that do people feel that they're actually now not only are they getting out of the cost of living crisis, but are banking their money into an asset that is worth something rather than paying out?
Good point. So I wanted to highlight the two other things that we obviously monitor closely around property sentiment here. And so the first one, time to buy a property, you can see that that's increased naturally. And so we're now seeing still in a pessimistic area, but a 17.7% year-on-year improvement. Now, the house price expectations, we've talked about this before, but if you're new to this update, people in Australia predominantly believe that house prices just go up and up and up, right? And that's what we're seeing in the average number there, which is tracking it over its historical term of this measurement, which has been several decades now. But look where it sits right now at 155. It is down 3.5% from its peak, which was 161. But the reality is that there's no doubt that as interest rates come down, Labor's 5% deposit policy is going to add fuel to demand. So we would expect that affordable areas around Australia will have some upward pressure on prices over the coming 6 to 12 months as rates come down, borrowing power capacity. So you'll start to see that movement. So we're pretty confident that this is a rising tide lifting most market ships. There will be some markets that will perform better, certainly in those affordability markets. And if you look at the demographics of your age profile, if they're in that 25 to 35 range, that's going to be a lot of first home buyers coming into market. So that in some respects is a good news story because we believe that every Australian should own their own home. It's vital. It's the best tax vehicle in this country. It's now even better than super in my mind.
Yep.
And with the changes that are coming, basically it's never taxed at the moment. I think I've got an argument there to say there should be a little bit of tax on your owner-occupied property. It's a story for another day. Let's keep moving because we'll be here.
Yes, that's a good debate. I like that one.
Yeah, I'm happy to have that one because I think at the end of the day,
I agree on that.
Let's roll that another. Let's do that as a project for next.
Let's just package that up. We'll put that for July, shall we?
We shall. All right. Let's now move on and have a look at retail sales. So we're off the back of consumer. So retail sales has been sluggish. So we saw retail sales rose by 0.3 month on month in March, following a 0.2% increase in February, but falling short of market expectations. So this marked the third consecutive month of retail turnover growth. Sales rose across most categories, including food, retailing. We saw other retailing also increase: clothing, footwear, personal accessories. Household goods retailing was unchanged after a 0.3% decline in the previous month. On the downside, we saw declines in cafe, restaurant, takeaway food services, and department stores also negative. In regions, and I like looking at this from time to time, but New South Wales, retail sales 0.5, Victoria 0.6, South Australia 0.2, Western Australia 0.3, Tassie 0.5, Northern Territory 0.7, and the Australian Capital Territory has scratched out a 0.1 of 1% increase. Everyone except for Queensland who had a decline of 0.4 of 1% in that. Now, remembering when you think about per capita, still not going in the right direction. It's not as strong as it needs to be. But to your point, we'll start to see households banking some of those savings, but a little bit more discretionary spending might creep in there.
And that this is always a laggard effect. So that we are still probably actually seeing spending habits from October coming through. So discretionary spending is the last thing to move. And that's what the RBA will talk about with the fact that they are always 6 months behind. And that's probably where we are, which is that we are 6 months behind in retail spending. It's always that sort of laggard gorilla, as I like to look at it, which is we are still not confident enough to start saying, actually, the release of the handbrake for the RBA, the change in fiscal policy is going to positively affect me enough to have the confidence to actually start spending. But, and I will say this, don't forget seasonality, end of financial year sales, all that kind of stuff. So June's always a bit of a problem because it distorts. Same with the start of the financial year in July. Point. So just, you might see this big pop up and, it's around the interest rates, and probably not. It's businesses doing what they do. And considering that they obviously, again, another possible policy came through, the instant asset write-off got jumped up as well. So more spending.
More spending, 20,000 instant asset write-off. Okay, so we look at the consumer, what they're doing, and that obviously informs business and their confidence and their conditions. So we saw the NAB Business Confidence Index rose by to a reading of negative 0.1 in April from a marginally revised negative 0.2 in March, reaching its highest reading since January. So that's confidence.
That's one way of putting it.
It's still in negative, but sentiment was mixed with a sharp rebound in manufacturing and a modest gain in wholesale, construction, finance, property, and business services. However, business conditions, they eased from to a reading of 2 from 3, dragged down by falls in profitability, because obviously their input costs are going higher and also wages costs are going higher. So profitability is -4 versus -2. So they're taking the hit. So they still want the business, but they're taking a hit on profits. And sales was a reading of 5 versus 7, whilst employment remained steady at a reading of 4. Conditions weakened in mining, transport, and utilities. Forward orders were stable at -0.3 amid a sharp fall in capital spending, 1 versus 6, and a dip in capacity utilisation, 81.4% versus 82.8%. Purchase cost growth was rose by 1.7% from a reading of 1.4, and labour costs steadied at 1.6. Now, this is where it gets quite interesting. Both product and retail price growth accelerated, the latter increasing from 0.9 to 1.4%. So we saw from the Sally Ould, who is the NAB's new chief economist taking over from Alan, what we saw there was both business conditions and confidence remains weak. And she highlighted the risk in the economy is struggling to sustain the momentum that we saw in 2024. So they are basically saying, if we don't get this little sugar hit from lower interest rates, the economic outlook and the growth in the economy is still going to be one of the biggest challenges in terms of trying to get us grow with a 2 in front of it versus a 1.
And that comes down to the fact that at the moment, business outlook is so hard to predict. I mean, we're going to come to it in the States, but it's here as well. At the moment, businesses, I've not seen so many businesses listed and otherwise just basically scrap forward guidance. That is because...
Well, how can you make any decisions?
Correct. So
that's
the problem.
He's changing the playing.
When he changes it's not even the goalpost. It's actually the size of the whole bloody field.
He's changing it from a chessboard to a checkers board.
Yeah,
like he's just making. Yeah. Anyway, we're talking about Donald Trump. We're getting to that,
and we're getting it. But again, just that's why that negative. I mean, if you're a business leader, as you said, you're a business owner, and so am I. Making forward decisions at the moment is so hard. So you're not making consistent 6, 12. 24-month period. You're making monthly decisions because it's that fast.
We like in business, we like predictability. Yeah. We like the goalposts not getting changed. We like regulation not changing. So any of those types of things have unintended consequences. Anyway, let's get into property. I want to just quickly summarize the quarterly results because the month can move around a little bit. We're seeing obviously Sydney back into growth, Melbourne back into growth, Brisbane still holding good growth, Adelaide still growing, Perth still growing, Hobart growing, Darwin a standout at 3.4%, Darwin at 0.6%. So we will continue to expect to see rises of around 0.5% in terms of month on month, and that's going to push up those overall returns. The other thing we also like to just spend a bit of time just thinking about is, and I'll push this chart out a few extra years rather than just looking at the sort of last 12 months, 24 months. I've pushed this out to a 5-year chart, and you can see when interest rates got down to basically 0.1%, we're off to the races in terms of property prices and spending. And that's obviously then when APRA put the throttle on with the 3% buffer, and that cooled off the market a little bit there. And obviously we went into COVID, the COVID recovery, but then that cooled off as interest rates and inflation took off. Firstly, supply, then demand-led inflation. So that's what we saw. So we just want to note that the owner-occupied value of loan commitments for dwellings in Australia declined by 2.5% quarter on quarter to 53.2 billion. And then we also saw declines in in investment lending, and we saw first home buyers also down on quarter 4 results as well, negative 3.2 versus 1.1. Now, I won't bore you with the broader numbers, but when you start to think about it, the reason why the percentage gains are so big over the year-on-year numbers is with the fact that, we're talking about that base effect. So we're sort of saying here, when you think about the results from the year before to these results, they look really strong, but in the global scheme of things, we're not even back to, those peak lending periods. But I suspect we will start to see conditions in the mortgage space improve a little further. All right, let's now wrap up with a focus on productivity. This is one of Dr. Chalmers, our treasurer, has come out and talked about this is his number one priority. And I couldn't agree with him anymore outside of spending less, all right? I'd like them to spend less because when you get productivity, you grow the pie and the pie creates more taxes. And so you don't have to increase our taxes. You just have to use that growth to actually pay down debt because we create more profit and more people working, more also tax-free income. Now, why is it important? Here is the clear context, and I'll just read this out to you in terms of what it looks like. The Productivity Commission estimates that higher productivity has accounted for more than 80%, 80% of national income growth over the last 30 years. And we also saw the Productivity Commissioner
come out yesterday, which is the 19th of May, with a new report of actually submissions for improving productivity, because what she also showed was that productivity is at a 60-year low. So there is now a 15-point plan, and one of the straight away she talks about, and this is Danielle Wood, this the commissioner herself. She talks about basically streamlining energy regulation. She's basically saying you need to rip it up. That's basically what she's saying.
Yep.
Streamline, particularly regulation.
Wouldn't that be nice?
Wouldn't that be nice? They want to also look at streamlining the availability of capital for infrastructure lending.
Sensible.
Yep. And a lot of them were, but they were the ones that really stood out to, in focus. It was interesting also what she was linking was, there's all this discussion at the moment about childcare, right? Linking childcare back to actually productivity in hours used. So there is a big argument that actually childcare being under sort of a state education system, although it's increased in spending, a lot of particularly conservative economists are against it. What the Productivity Commission is showing is that it actually increases dual income families by a rapid amount. More women in work actually will lead to greater productivity. We're a service economy. So what she's basically saying is that we need to get away from this idea that childcare has to be an expense to the family, because it's actually quite cost effective. Why? More people working means more tax dollars.
Well, we had a little bit about that debate last year, didn't you?
Yeah.
You were quite positive on this. I was a little bit unsure, so I'd have to continue to keep doing my reading on it.
She is actually now showing that actually with women entering the workforce at record numbers, part of the reason why the Treasurer has got to roll out 2 surpluses is because personal income tax is up. And where's that coming from? Dual income families, women.
Well, the first surplus was the $90 billion spent. That was just basically coming back.
The second one was because we were all working.
Correct. Because we were spending all the money to make working. But here's a couple of examples, right? Productivity in the building industry has fallen by 12% over the last 30 years. It hasn't increased in over 30 years. Australia is getting worse at building houses, property, things that we need. The problem that we've got is the red tape and everything aligned with this whole idea.
Here's one for you.
Yeah.
When do we start using European standards rather than Australian standards for what building products are?
When do we rethink about the whole concept and start thinking about printed homes, 3D printed homes, modular homes, and start getting the regulation? I mean, one of the better policies for the coalition in the housing policy was no changes to the building code for the next 24 months. Just no changes. In other words, stability. So we can then start, designing things that fit the building code, because you change the code and all of a sudden now tooling and everything that we want to do in terms of making it more productive and more efficient to actually build, we've got to go and change it because you change the code.
Yeah.
And
so when do we accept fabricated house?
Oh my God. And what about energy standards?
Yeah.
Like we want these
7
best
stars?
energy. Yeah, like crazy, absolutely mental decisions that we have to make. Now, here's another example. Obviously, business versus government on the productivity front. Businesses try to drive productivity. They really do. But government policy, they're the rule setters. They set the rules of the game. They set the boundaries and they also set the incentives in terms of what's possible. So at the end of the day, productivity is the responsibility of the frameworks of government. So smaller governments with less regulation actually generate a lot more productivity, which generates better outcomes. So here's some further examples. Productivity outcomes across health, education, and public services. Who funds most of these things?
Tax.
Governments. Governments basically spend on health, education, and public service, and they've been abysmal with an 18-year low in productivity. So that just again goes to show you, we had a problem over here, so let's put some more regulation in around that, and so that's gonna make sure everything's okay.
It's also more money, right?
Correct.
So there's always been this argument, more money at education will get better outcomes, which we've shown is not necessarily the case. And it's the same with health.
Get out of the way of business and watch magic happen.
But it's not just that. With health and education are a fundamental part of how you improve productivity.
Mm-hmm.
I don't completely agree with that.
Yep. Education is essential.
Absolutely, it's essential. So to some extent is health. The catch that we have now is that the way that we not just fund health, but how you have access to it and who falls under health is the problem. So the aging population is the bigger driver.
Yep.
And so one of the productivity arguments about health is that, start talking about health in the home, right?
Yep.
Don't have to pay as much hospital beds, right?
Yeah.
Don't have to have as many regulations around that. Don't have to have as many administrators in a hospital if you can do health from the home. Virtual home.
Clever.
AI health.
Yes.
All of these things,
they will be helpful.
So these are the productivity gains that can happen and still keep the level of care that the community expects. But money isn't the answer to everything, right? And that's, I think
we've seen that in a lot of areas. You throw money at everything, it doesn't work. So let's wrap this up. It's probably not really a special focus. It's more like a rant.
Yeah.
But let's finish off by
because we have now been talking about Australia for exactly an hour.
Okay. Bottom line in this is that productivity gains are essential for unlocking economic potential, which in turn is essential for sustained growth and the improvement of living standards across the board. So it absolutely, people argue about the trickle down. And this is slightly different in trickle down economics, but the principles are simple. That is, if we're more productive, then there's more money. That means more can be paid to the people who are more productive. And that obviously it means more can be shared around and we can be more efficient in terms of looking after those most vulnerable in our community, instead of regulating the crap out of everything and having the unintended consequences, which is lower productivity. Rant is over.
Fair cool.
Okay, let's wrap up the Australian market. So what are we talking about here? Obviously, government focus on productivity. We agree with you. So please get onto it, Treasurer. It's in your wheelhouse. We love to see what you're going to be doing with that. In terms of the cash rates, 2, 3, 4 for you.
I think there'll be minimum one more.
minimum one more. I might go 2 more and be a little bit just, so we've
I think there's a real chance of 2. I think minimum 1, probable 2.
Yeah. Unlikely 3
I think probably the question is when. August would be the likely date.
I don't mind that argument at all.
Yeah.
I'll buy into that.
Yeah, with the idea then, as I said, rolling 6 months, they'll have 3 rate cuts to evaluate.
Yeah.
And therefore, it may not happen in November, that it will be the first meeting in 2026 that.
Okay, so base case is 1 more cut in August.
In August?
Yeah, and we wouldn't be surprised if there's one in July, but we don't see a case for it.
I'd be very surprised if they moved in July.
Fair enough. But that just means that they're looking to potentially put a couple more in to see how the economy is actually going. As I said to you, if it's not today, and maybe our team can find out what some of the banks have announced in terms of whether they're passing on the full 25 or 20, that would be interesting before we close out today's show.
I still think they will. I think they have to for this one.
Yeah.
I agree, though, the debate for the next one is up.
Oh, yeah.
And again, if there is going to be one that's going to be the anger one, it will be ANZ, because they are the ones with the lowest margins in their book.
Good call. And now, obviously, from a property point of view, we do expect prices to have upward pressure on them based on where the market's at and the demand side versus the undersupply that's currently in Australia. All right.
And now we've got fiscal policy that we know is around supporting housing, because 5% to 15% government guarantee.
It's going to happen. Right. So ultimately, here we are. Now let's look at the US, and we want to update here on the Trump experiment.
So good 55 minutes of that one. Yeah. Buckle up for the next 25 minutes.
Oh no, we started sort of 2:20. We're just under 52 minutes.
Yeah.
All right, here we go. Trump experiment. Right, 90-day pause.
This is where I do my rant. Keep going.
Yeah. Well, it's clear that the experiment is failing now, depending on whatever spin he tries to put on it. But what we have seen is obviously we've got 10% US goods, and then we've got a 30% blanket goods for Chinese goods going into the US. So the Chinese manufacturers are now sitting in there working 24/7 to try and get their produce on a ship and trying to get it on the shores in the 90 days so they can have that reduced tariff. Because we did see a major change there, and I'm going to let you have your rant in a second. So the art of the deal versus the art of the real, it's been very clear that this experiment didn't work. And it's also clear, because we're going to talk about the bond market, that basically showed up the strategy and got it. At the end of the day, always remember the bond market rules.
In the words of Bill Lurry.
Yes. Now let's hope there's less erratic behaviour, because now that's all part of the deal, the art of the deal, and then obviously what's next. So talk us through what you want to sort of share with us in terms of the tariff experiment.
First and foremost, if you have a look at what the 90-day pause, so another diary date for you guys to put in is the 9th of August. What is that? That is the end of the 90-day pause, which has been described. It's not really that. It's the end of the 30% tariff, because that's where we currently sit. So we've gone from 145% tariffs to 30%.
Mm-hmm.
What I want to point out is that he talks about getting this deal from China. He's actually got nothing. And what I mean there is the only concession the Chinese gave him was to take the retaliatory tariff they put on the US goods. That's it. Nothing else changed. They didn't open their markets to US products. They haven't allowed US companies into China. They haven't shown that they're going to stop doing anti-competitive behavior or any of that kind of stuff. Nothing happened. And that's why the tariffs were always going to lead to this scenario, which is the art of the deal, was he was trying to refer to it, wasn't even there, because the Chinese didn't come to the table. I also want to point out, even with Japan and South Korea, which look like being the ones that moved, they weren't actually moving.
And the UK deal was a nothing deal.
It was a nothing. And not only that, as people pointed out, the UK is 4% of US trade.
Yeah.
Right. So it was just so tokenism, it wasn't funny. And that brings me to what really happened, is that Liberation Day created such ruckuses and such a disruption to global trade. I mean, as you know, the jokes were being made far and far between. Australia was involved, so Marshall Islands, where basically it's a independent island that we technically have sovereign nation over, that only has penguins on it,
produces nothing,
it has no production, somehow had 100% tariff on it. Norfolk Island, which is also
under our
jurisdiction, wasn't getting the 10% that we have here in Australia. They were getting 29%. Where the hell did that come from? But again, putting that sort of facetiousness to one
Maybe
side.
they take the crayfish.
Maybe they do.
Maybe they do.
Maybe they still make their shits with.
Or
melting pots.
maybe they get 2 crates of wine a year.
Possibly. Yeah. But this chart is what I wanted to really highlight, is that this is what got him. So you can see that massive spike up in the 10-year and 30-year yields of US government bonds. Now, you've got to remember, go back fundamentally what this is. This is basically US mortgages, right, for the government. This is for 30 years of borrowing, they have to pay 4.79% on that 30-year bond average. Now, it at one point got up to as high as 4.81. Don't forget, depending on who you listen to, it's either 1.4 or $2 trillion of structural debt issues in the US. So if you're having to pay an increase and are issuing new debt of $1.4 trillion a year, all of a sudden your affordability goes through the floor. And that's what happened here, is that all of a sudden the guardrails that normally would be Capitol Hill, so Senate and the Congress, or the Department of Justice, or the DOJ, or even the Fed, which was sort of also dealt to the side, those guardrails might not have caught him, but the one that got him was the market, because all of a sudden he had to back away because he was making the US unfundable, is the term.
Well, I think Scott Besson had to go and have a chat with him and say, hey, our latest debt offering, and the rumors have it was that there was a group of bond buyers out of Japan. The script wasn't filled, and that's just never happens in the US, right? When they issue the debt to be filled, basically they couldn't get it away, and that's what spiked the 10-year and the 30-year bond. And it was at that point that all of the potential Doge money that they were potentially saving and so forth, but with their debt is around, if I've got this correct, it's 7% of GDP. In terms of their cost of service debt is around that sort of level. Now that's
forecast to hit 9%.
Yeah, is it 6.7 trillion? Have I got that right?
Yeah.
So that's $6,700 billion. That's a trillion. So a billion is 1,000 million. 1,000 billion. Sorry, a trillion is 1,000 billion. So we're talking basically the market got him. At the end of the day, they had to ease off, and then they had to change tactics. Now, obviously, on your next slide here, you're seeing that there is absolutely an uptick in terms of the tariffs. And so he will claim some sort of victory, that it was part of the art of the deal. And, we've now got an extra $100 billion a year. But you just wonder whether to get that $100 billion of additional.
So it makes
maybe it might be more, might be 200
but
billion.
So the other catch with this, and what we just discussed, the last one of these updates, was the whole concept of these tariffs was that it was going to fund the other side of his promises, which is
the tax cuts.
Now, how can he do that?
No.
So the reason why it's interesting, you pointed out before, are we going to get some stability, is that he is now facing down midterm elections, which are in November next year. Now,
he's got a big tax bill. He's got his big, beautiful bill in Congress right now, trying to get those baked in tax cuts that you got in 2022. Yeah, so, but there's also got record spending.
Yeah, so he's got a problem. He's got a problem in terms of how he does this. He's never going to reach the 150,000 tax-free threshold that he promised. I think at best, he's going to offer 75. And even then, I don't think he can do it, because you're already hearing rumblings, particularly in the really conservative fiscal side of the Republican Party, that you can't do.
No, the moderates are not supportive.
They're sitting there very clearly going, we can't fund this. Like we genuinely can't fund it. And then you look at this chart, and why I wanted to show you this is that you can see that historically it's not very high. But the reason the US has, been the biggest behemoth player on the planet is that they are and have benefited from trade more than any other. I mean, we forget services and particularly technological services over the last 35 years has been led by one country, and that is the US. And they continue to rate that in.
Financial services, general services, software services, insurances.
They're the best at it.
They are miles away. Education, like all of that sort of encompasses their greatest exports. But then, they've got mega companies that, in terms of fast-moving small goods, they own most of those outside of Nestle.
Yep.
In terms of, so they do all right in terms of our share of supermarket wallet. And
so what's so fascinating about what's happened over the last 6 months in particular is that you now have another scenario where right now, there you go. So I'm going to stop because we've just got some breaking news. Go on, Ben.
So NAB, Westpac, Combank and ANZ have passed on the rate cut. So I was wrong. And Evan was right in terms of...
I didn't think it would be this one. It would be...
I thought this would be the one.
It'd be tough for them to do it.
Okay, we'll see what happens next.
The next one, or if it's not the next one, if there is a fourth one this year, then absolutely. But I didn't think it could be this one. There was too much going on for that to happen. Back to what I was saying. What was fundamentally lost by this whole thing, there is actually a strategic argument to be made that they could have gone very, very specific, very, very strongly at China and certain areas. I mean, there's a reason why Elon Musk is so annoyed with China. I mean, if you think about it, BYD is a carbon copy of a Tesla, just at a cheaper price. Mm-hmm. When did Elon Musk put Tesla manufacturing into China? He did it through the tens and early sort of mid-teens. And all of a sudden, this company that didn't exist 7 years ago, BYD, is now the largest manufacturing of EV vehicles 2-1 on the planet.
Yep.
So targeted tariffs can work because it's more of a sanction rather than an economic/tax policy.
Yeah. So I think Trump is going to have to eat some humble pie. He won't eat it. He will never admit to it, but that's basically what's happening here, and that's okay. Let's move on now because we've got a fair bit to cover off, and we'll try and get through a few of these charts as much as we can. So let's look at the GDP. So we saw this come out at the end of April, so we haven't updated this one yet. But this is what we have seen. The US economy contracted at an annualized rate of 0.3% for the first quarter of 2025, marking the first decline since the first quarter of 2022. This was a sharp reversal from the 2.4% growth in the previous quarter and came in below market expectations of 0.3% growth, according to the advanced estimates. Now, this is off the back of Liberation Day, which obviously happened there. So we saw a 41.3% surge in imports contributed to the slowdown. Because you remember, gross domestic production is exactly that, domestic production, not what you're importing and selling so much. So it has a big effect in terms of the overall amount that you're generating in the economy. You still get the consumption side, but you don't get the production side in terms of those numbers. So that contributed to the slowdown as business and consumers rushed to stockpile goods in anticipation of higher costs following a series of tariff announcements by the Trump administration. Consumer spending growth has also cooled to 1.8%, the slowest pace in Q2, and we're going to get to that, Q2 of 2023, while federal government expenditure, this is not a bad thing for me, fell by 5.1%, the steepest drop since Q1 of 2022. That's what happens when you stop US aid, as an example in terms of some of the savings you potentially get there. So let's move on now in terms of the labour statistics. And then we'll have a broader commentary about that. So we saw the labour data come out from the Bureau of Labour Statistics on the 13th of May. And we saw the annual rate of inflation in the US eased to 2.3% in April, the lowest since February of 2021, from 2.4% in March and below forecast of 2.4%. Energy costs declined 3.7%, more than 3.3% fall in March. Prices for gasoline, negative 11.8% off the $60 a barrel, $70 a barrel range, down from negative 9.3%. So that's really coming off. Fuel oil, negative 9.6% versus negative 7.3%. So they're disinflationary right now, decreased by a faster pace on natural gas. Natural gas soared by 15.7% from 9.4%. I suspect that's a one-off anomaly. Inflation also slowed for food, transportation, in terms of steadied for shelter. On the other hand, prices increased faster for used cars and trucks and also new vehicles. Let's move along now in terms of how that affects the interest rates. So long-term interest rates, and I think we'll spend a little minute on this. Long-term interest rates are now notably higher, driven mainly by increased real rates rather than shifts in inflation expectations, while estimates for longer neutral policy rate has also risen. That's what the Fed Chair, Jerome Powell, said last Thursday. Now, speaking about the Fed's ongoing review of its policy framework, which was last updated in 2020, Powell also said the economy has changed a lot since then.
Understatement.
Let's read into this because this is really important. Speaking of the Fed's ongoing review, he said he warned that inflation might become more volatile. Funny. In the future due to more frequent supply shocks, which could make it harder for central banks to achieve price stability. Through his remarks, Powell also stressed the critical role of anchored inflation expectations, which have underpinned several of the longest US economic expansions. He is lecturing to Donald Trump here, basically saying that the more you play and change the game constantly, you create these supply shocks. We were talking about it before we came on air, about basically shipping out of China just literally stopped. Ships into Los Angeles ports just stopped. And now, 90 days. And so boats are getting filled, prices are spiking for containers, and the whole thing is just creating the supply shocks. And he's saying that's not an easy place to set monetary policy if you guys keep continuing to move the post on fiscal policy. And he also just wanted to give them a reminder that underpinned longest term of economic expansion happens when we've got inflation expectations under control.
Yeah. So your business argument before is if you can't or see your future pricing and your future earnings and your future revenue, you're not going to make decisions and you're not going to make choice. So
no capital expenditure.
Yeah. The example that I kept using about why there's been this bias strike into the States and what you talked about before with the shipping issue. So some of the big major German shipping companies have reported to the DAX that they haven't just had pauses, they've had cancellations of up to 30% of seaborne shipments from China to the US. What that shows you is that, again, going back to when this was happening, it was 145% tariff on Chinese goods. So if you were importing, let's say $100,000 worth of goods, you were paying the IRS $145,000 for that right. So $245,000 of costs for $100,000 worth of goods. That's a lot of margin you've got to put on to make your business work.
And of course, it was cheaper then to cancel the order. Even if there was a financial loss in the cancel of the order, it'd probably be 20 or 30 grand, right?
Yeah,
so
correct.
Ultimately, it's better than paying whatever it is. Now we've got this, a tap on, tap off scenario, and
you still can't make decisions on 9 days.
Of course not. And so this is where the Fed's commentary is really strong here. He said, and his independence, he reaffirmed the Fed's strong commitment to its 2% inflation target, noting that without well-anchored expectations, the recent disinflation will likely come at the cost of significant job losses.
What's he just described? Stagflation.
Correct.
So he has literally described stagflation of what we saw in the 70s, where you had rapidly increasing inflation, rapidly increasing unemployment, flatlining or negative growth. So we've just seen a negative quarter of GDP. We haven't really started to see it, but as Ben's got the chart on screen, it is starting to get a little bit of an issue at 4.2%. You hit 4.5% by July, then it's on, right? It's on.
The recession aspect of this, and we already are hearing from podcasts we listen to in the States around sort of saying that they are laying off salespeople and they're laying off the sort of non-essential because the consumer is also scared off the back of this. But we saw here that the US unemployment rate was 4.2 in April. So you can see the data there. There was an increase of 82,000 to 7.165 million, whilst the employment grew by 436,000 to 163.94 million. Labour force participation rate also edged up to 62.6 from 62.5. So this is what we want to watch out of the US, because this is the canary in the coal mine when it comes to what's about to happen to US consumption, which is effectively, we've always said it's pretty much 20% of dollars spent globally is spent in the US in consumption. So that's also interesting. And this further reaffirms what we were just talking about. The consumer has crapped themselves in regards to these discussions, right? So when Trump got elected in November and December, things were, look, he's a businessman. He knows what he's doing. You got the businessman in power and basically, and he's trying to get a good deal for America. Make no mistake, he's trying to do that. But what we have seen in terms of all of these executive orders and everything that's going on, he's running hard. And he's running hard for a program of works over the next 18 months before the midterms happen. And he's trying to get, so he's got challenges now. But we did see consumer sentiment in the US drop sharply, 50.8 in May, down from 52.2 in April, and below market expectations of a reading of 53.4, according to those preliminary estimates. Now, this marks the 5th consecutive monthly decline and the lowest reading since June of 2022. And this is the second lowest on record, as mounting inflation expectation and renewed concerns about the tariff continue to weigh on sentiment. So both on the current conditions and also the expectation gauge also worsened. So the current assessment of personal finance sank nearly 10% on the basis of weakening incomes. People are paid with commissions and other ways in which they're paid, and the economy starting to slow. Tariffs, I love this line here. Tariffs were spontaneously mentioned by nearly 3/4 of the consumers up front. And that was from a 60% commentary in April. So that is without the surveyors who ring them up and get all these collections. They're sort of saying, oh yeah, I'm worried about without even asking, they're worried about the tariffs impact on their finances. So the consumer over there has worked out that this isn't a good news story. And that obviously has meant we've seen that decline. And then here we are in terms of the retail sales. Let's go back to those retail sales. We saw retail sales rose by 0.1 month on month in April, following an upward revised 1.7% surge in March. The modest gains suggest consumers scale back spending in response to the wave of tariffs announcement in early April, yet the retail still exceeds market expectation for no change. The biggest increase was seen in sales at food services and drinking places, building materials and garden equipment suppliers, furniture and electrical and appliance stores. On the other hand, the largest decreases were recorded in sporting goods, hobbies, music, instruments, discretionary stuff, bookstores, discretionary, miscellaneous retail stores, gasoline stations, obviously lower prices, that's why that went down, clothing, health, personal care, and general merchandise stores.
So the interesting thing about what this is and why it's also fascinating, what we've also seen from the data, things like auto sales in the US, consumers front running the tariffs.
Yeah, that's right.
So they are massively increasing inventories to try and get ahead of it. You're also starting to see, for instance, having a look in here, like the household, there has been some incredible data coming out. Like, for instance, random things like 99.8% of all alarm clocks into the US manufactured in China. 70% of all like pushers and prams, China. Random things across the home. The majority, if not all of them, are manufactured out of China. And at that time, when this survey said 145% increase in costs, what do you expect them to do?
What do you expect? So we, again, always start with employment, go down to the consumer, what they're thinking and how that's impacting business confidence. And we saw here that the IMS manufacturing PMI in the US slipped to a reading of 48.7 in April from 49 in March, slightly above market expectations of a reading of 48. The reading signaled a second consecutive month of contraction in the manufacturing sector as output shrank more sharply and prices rose further. Meanwhile, new orders declined at slower paces, hence we're putting our hands in our pockets, people, and new export orders also fell more steeply amid ongoing tariff-related disruptions. Meanwhile, the rate of job losses moderated slightly. The IMS survey also revealed US manufacturers were grappling with rising costs and margin pressure, whilst ongoing trade uncertainty was disrupting supply chains, causing shipping delays, complex duties, and frequent changes in cost structures. At the same time, they said the consumer demand was becoming more volatile, with some clients delaying orders or pushing tariff costs back on manufacturers.
This is what we've been talking about.
Here it plays itself out. So there you go in terms of that. So let's wrap up the US. We're seeing here that maybe we've seen the worst of this rapid shock agenda that we're seeing through these tariff wars. So let's see. Let's hope that is the case. Or there will potentially continue to be, if we get this economic flip-flopping, that will obviously mean that so-called master plan, as he'll eventually call it, whatever money he does raise, he says the US never had that before. So he'll spin the story in the way in which he wants to spin it. And the tariff impact will start to show up more in the data in the coming months. So it is a fascinating experiment. I call it that. It's certainly one to watch.
If there's going to be a recession, it's going to be at the end of this year, and that's when tariffs are
here first.
When the tariffs are actuals, they're baked in, and it's now creating a sustained structural change in behaviour.
Now, this is also a problem for China. They're not going to get out of this lightly either. In terms of what we're seeing here around the annual inflation, they've got disinflation or deflation.
They've actually got
deflation here in these numbers. And so what we're seeing is the consumer price dropped to a reading of 1.1 year on year in April, maintaining the same pace for the second month and matching market expectations. It marked the third consecutive month, as you can see on our chart there, of consumer deflation, weighed by the combined efforts of ongoing trade tensions with the US, weak domestic demand, we're going to get to that in a second, and persistent employment uncertainty. Core inflation, which excludes those volatile items of food and fuel, rose by 0.51%. So they've got, deflation there, but still not good. Holding steady for the second month. On a month-on-month basis, the CPI did edge 0.1% higher, reversing a 0.4% drop in March, and recording the first increase in 3 months on a month-on-month basis. All right, so what did the People's Bank of China do? Well, they're not doing anything at the moment. Basically, they're waiting to see what plays out with the discussions with the US. They are readying themselves up for more stimulus, but they just don't know how much they're going to need until they see what basically happens there. So there's not really much more to report until we see what happens around those negotiations.
The other one to watch then is what we refer to as the reserve requirement ratio, because again, Chinese economics is tightly held by the state. The amount of capital banks have to hold over the last 15 years has been slowly but surely getting smaller and smaller. So they're trying to put more money into the economy. That is the one that is moving, and it's now at the lowest it's ever been. It's now sitting at a reserve requirement ratio of 12%. You've got to remember, just before COVID, it was at 20.
They had a lot of cash.
So they are putting money.
They're using it where they need it. All right, so let's have a look at in terms of the unemployment rate. So we got this read on the 19th of May, and the surveyed unemployment rate edged down to 5.1% in April compared to both market expectations and previous months of 5.2%. This marked the lowest reading since December of 2024. Across the 33 major cities, the urban surveyed unemployment rate also stood at 5.1%. So they're not terrible numbers, but
China, that's
for the size of the population, they're not great numbers.
That's the problem. And again, what we're showing here is that the middle class that we've been hearing about for the last 20 years that is coming to the rescue of China is actually the one that's now feeling it.
Hundreds of millions of people that they've got into the middle class.
Is now feeling it.
They're feeling it. And this is showing up in this chart here. Now, Evan and I were also talking about this. So what I did is I went back and did a 10-year chart, because you can see here, obviously, COVID hits through this period. We were debating whether this was accurately reported or whether this might have been controlled by the administration, let's call it. And then at some point, they decided to actually publish the real numbers, is one argument. But you can see here in terms of consumer confidence in China decreased to 87.5 points in March from 88.4 in February. Now, for context, consumer confidence in China averaged 109 points from 1991 to 2025, reaching an all-time high of 127 points in February of 2021 and a record low of 85.5. We are touching on those record lows here in November of 2022.
And while we were having the debate, what is so strange about this chart is that the drop-off, that incredible fall from about 112 to basically 88, so from optimism to pessimism, coincides with the release of China from their COVID restrictions. And why it's so weird is that everybody in the rest of the world was expecting them to have the renaissance that every other nation had out of restrictions and that liberation of having your freedom back. What the argument is that they actually probably were sitting at this level of confidence throughout COVID and have never got it back, because unlike where there was huge amounts of stimulus from other nations around the world, China sort of kept things almost status quo. Nothing's really changed. And therefore, you're actually now showing and feeling that COVID even hit China just as hard as it hit the rest of the world. In fact, if not worse. and they have not recovered and are not recovering. Their confidence is, it's, as the average said, it's extraordinary to see pessimism in a country like China, where it is always seen with an optimistic.
So very proud for a good couple of decades there. Okay, so let's move that along now in terms of looking at the Bureau of Statistics results for their retail sales. And again, you can see I've got this chart going back 5 years. You can see some really strong numbers. Now, when you look at the historical, for a couple of decades there, those were really solid numbers. The GDP was clipping at 7s and 8s and 9s at some point. Consumption was through the roof. So we're basically just saying there that it did increase by 0.35 in February from the previous month. But it's in terms of sales and sales months in China, the consumer's not spending. And they need to do something about that, because if they're not going to get their goods sold offshore, they're going to try and have to sell them locally. And that then obviously leads into their business confidence. And you can see the rapid decline in business confidence off the back of the Liberation Day tariff announcements. Actually, for China, it went from, we'll put another 25. And they said, well, we'll put 25 in. It was hilarious to watch, but it was destroying capital markets at the time. China's official NBS manufacturing PMI fell to 49 in April from a March 12-month high of 50.5. This marked the first contraction in factory activity since January and the steepest decline since December of 2023, despite Beijing's stimulus measures aimed at supporting economic recovery amid growing concerns of the impact of the ongoing China-US tariff standoff. So not a good story here in terms of what we're seeing there. And so how do we round out China's story? Economically, short term, it's going to be challenging for them. They've got a lot of problems, and so that the administration and the regime over there. Can I call it a regime?
You can.
I can. Well, most people don't like me calling that. I can't call them socialists. Some people get offended by that. Anyway, they've got challenges, and so we know that medium term and a few other things that they're thinking longer term. But it's really what happens out of that deal with the US and how quickly they can get that settled down, and the world can have some normality to it, whatever that ends up landing like. But we talked about the benefit to Australia is potentially some dumping of goods down here, so that makes things.
So if we're talking about interest rates and where could they actually export their deflation story? So do they bring, as Ben said, those goods that have been manufactured that now need to find markets to elsewhere, including us, bringing goods pricing into either neutral? I mean, goods pricing in Australia is almost actually now going backwards.
Yep.
So this is, again, it's hypothetical, but there is signs from 2017 through 20 when the first administration was in that China did look for other markets when the first set of tariffs were put on. So this is the next question about China will have to find places, wares, and needs to move its materials.
All right, so let's bring it home now. Quick little update on the Eurozone in terms of what we saw in the data. So we're looking at the level of annual inflation released by Eurostats, and it was released on the 19th of May, so it's relatively new data. Consumer price inflation in the euro area remained steady at 2.2% in April, slightly exceeding market expectations of 2.1% and hovering just above the European Central Bank's 2% target midpoint, according to preliminary estimates. Now, we saw a sharp drop in energy prices, negative 3.5%. That was offset by faster inflation on services, always a worry, 3.9%. And then you also saw food, alcohol, and tobacco rise. In terms of non-industry goods, also rose by 0.6%. Meanwhile, core inflation, which excludes those food and energy prices, climbed to 2.7%, up from the March 3-year low of 2.4%. So it's not heading in the right direction. So they'll be careful in terms of what's happening there. Month-to-month basis, we saw the CPI increase by 0.6% in April, matching March's rise. Then we move on to the rates decision. Well, good news is we don't have a rates decision. They're having theirs later this week, Thursday, I think, the 21st.
Yep.
So no, that's tomorrow maybe, but Thursday our time. So we see what's happening
Wednesday
over there. Now, I also then wanted to show the long-term unemployment story here so I've got a 10-year chart up here, sort of going back through that period. Now, obviously, the Euro area is a combination of all of those countries. And so when you put Greece and Italy and a few of these other sort of smaller countries that weren't weren't going too well in terms of how they were managing their economies. We have seen the euro area done a reasonable job in terms of getting that unemployment rate down to 6.2%, which was the March reading. But you can see there in terms of that's good, but it's still too high. Like in terms of you need your economy a little bit more productive than having basically 6.2% of the population not working who want to work. All right, then we move into the consumer confidence and sentiment story. So we have seen here, it's the chart tells the story, right? It's not pretty. Consumer confidence indicator in the euro area declined by 2.2 points to a reading of negative 16.7 in April, marking its lowest level since November of 2023, and confirming those preliminary estimates. In the broader European Union, sentiment also fell by 2.1% to a reading of negative 16. The downturn was driven by worsening perceptions across all four components: consumer assessment of their past and future household financial situation, ouch, their intentions to make major purchases, not at the moment, expectations for their country's general economic outlook. Just negative sentiment.
You got to remember, the European Union was hit as one of the hardest around the Trump administration tariffs. So, particularly if you're a Germany or a Central European country that is a manufacturer of high-end products, cars, you were absolutely in the crosshairs, and he was making all of that noise. Don't also forget, politically, the administration was walking across to places like Frankfurt and also to Brussels and saying all sorts of fairly interesting things. So it's no surprising that the European feels quite a lot of pressure.
Yeah, and I think, just quickly building on that point, the Ukraine war and now the US basically saying,
we're going to end it whatever hell.
Yeah, and military, you guys need to, NATO forces, you need to build up your artilleries and your, weapons, and that's going to come at billions and billions of dollars of cost. So, they're going to start having to spend more money, increase their government debts as well. All right, we'll finish off with retail sales. You can see here May 7th result. Retail sales in the euro area decreased by 0.1% in March. Over the previous month, retail sales remain choppy at best. And then we start to see the business confidence. So you can see in this chart clearly the COVID period. And then after Russia invaded Ukraine illegally, you can also see the impact in terms of obviously energy resources that were coming out of Russia into Europe had a big impact in terms of their economic costs and outputs. And so we saw business confidence in the euro area increase to a reading of negative 0.67 points in April from a negative 0.72. So a slight uptick. So it is improving, but ultimately it's still in pretty ordinary territory as they continue to keep, battling on in terms of their overall situation. Now, I want to move on to effectively talk about the takeaways there really quickly. It's flat, it's challenging in the euro area, and that's going to continue. Business confidence is still struggling. ECB, to your point, Evan, and the government really need to think about how they're going to manage monetary and fiscal policies, and they've still got plenty of work to do. Now, before we close out, I've got some latest numbers for you around the cash rate changes from the banks, because for every day that the bank doesn't pass on that rate cut, it's worth millions of dollars in interest earned. So here we go. NAB, effective 30th of May. CBA, effective 30th of May.
So 10 days from now.
ANZ, effective 30th of May. So they'll get their margin creep there. Westpac, effective 3rd of June. They'll pick up 3 or 4 extra days of a couple $100 million. And that's ultimately where we're currently seeing those.
That's 2 weeks from now.
Yeah, that is. And
14 days.
And there's some others who are moving a lot quicker than that. So that just gives you an idea of what the big banks do in terms of managing margin.
Let's point that out. Athena, for example, they're moving today.
Yes.
The 20th of May, they are moving officially.
And Unloan are moving today as well. Okay, so that's a wrap from us. I hope you've enjoyed us and you've hung around to the end.
It's a big one today. That's an hour and a half.
Well, these 6-week periods, and there's a lot happening in that 6-week period. We had the equity markets collapse and rebound. We've had an election. We've had all sorts of things going on. So we will see you again on the 8th of July. Until then, remember, knowledge is empowering, but only if you act on it. And thanks for sharing your time with me, Evan.
Always looking forward to seeing you on the 8th of July. Till then, keep well.